Every other thing we are going to be treating right now is in addition to, it doesn't have to do with execution, but then from lesson 3 up until lesson 8, that is what's covered technical analysis and execution. So from lesson 3 up until lesson 8, if you've gone through all of the practices and practice over and over again, congratulations to you. You are now a half big trader where you can execute trade and hopefully you can make profit from it, because that's all you need to know to analyze the market and see opportunities to trigger to either buy or sell. You are good to go. But then to make you a complete trader at the remaining two sessions we're going to be treating, which is this and the next one, which is the last. For this is very important because what you've covered from lesson 3 up until lesson 8 will help you make money in the market. But then trading is not just about making money, it goes beyond making money, because making money is one thing, being able to preserve that money over long periods of time, making withdrawals and still preserving your capital is another different ball game entirely, which is heavily dependent on you as a person, you as a human, you as a trader. But then every other thing we treated is system. It doesn't really require you to believe it or not. Whether you believe it or not, what I taught you, it works. Whether you think it or not, whether you know it or not, it works. Like, it's not dependent on you. But this part, the remaining two lessons, is very heavily dependent on you. The other ones are systems, and they work with or without you. But then risk management is very important. So you might ask me, what is risk management? What is a risk management? From the word as you hear it is managing risks, but then that is a vague word. Why? Because it doesn't do justice to it, to you just coming into the market. Because once you make your first deposit, you make your first deposit after practicing and practicing in the the sessions in the previous video. I said you'd be good to go, you feel confident to, it's only then and then you practice and practice on demo accounts. It's only then I recommend that you go on ahead and fund your account. Else you have no business funding your account and wanting to trade yourself if you've not, you know, crossed and practiced and executed on demo account. You have no business with trading live account, right? But then at the stage where you funded your live account, you know, is a different ball game entirely, where emotions start setting in, because now money is involved. Because you'll notice, if you practice these things that I've said, it will just work for you. Like, everything will move fine, you make profits, you, everything will just be easy, because there's nothing there like obstructing you mentally. But then once your money is involved, especially money you worked hard for, then the same things that you know, they'll start looking different for you. Why? Because money is emotions itself. But then you won't allow emotions, you won't control. That's why it's not sustainable for you to control uh or manage your account or trade your account based off emotions and just random. You have to put structures in place. You have to put system in place to be able to protect you. So first off, in risk management, you understand that you getting into this space, everything is risk. Risk now is not foolishness. Risk means uncertain the uncertainty part of things, because take it or leave it, regardless of whatever it is I've taught you, some will work, the same thing, some will work, some will fail. The market is uncertain, but then it's just that the probability of um, things going in direction of, if you apply those things we say, is more higher than you lose, because You have to understand that this market is not a static thing, it's things that happen in real life. Today, market might be forming normal structure. All of a sudden, President of the US, Donald Trump, might just come out of nowhere and say something that me and you don't know, and it will change the course of market. Something might happen between US and Iran that me and you don't know, it will just happen on the random, that what you are seeing now will just switch up. So those little factors between two nations, between two presidents, between two continents happening are not things that like we have control over. So that's why this particular topic is important to say, oh, even though you've tried this and it has worked, you won't just go blindly and be trading. You will put structures in place to manage that risk so that should anything happen after all is said and done, you are still protected. You now being protected is your capital. Capital preservation is your job as a trader. Your first your priority is to stay in the game, because once you blow your account, once your capital is gone, there's no more game for you, because even though you see opportunity in the market, unfortunately for you, you wouldn't be able to take on those opportunities if you are out of the game. So first thing you should be thinking is not just how to make profits, but this particular session is to reframe your mind. It's a conversation, but then from experience you would gain, but then you don't have to, you can learn from other people's experiences, example like me that I'm telling you, and other resources that you might find. Capital, your head should always be thinking capital preservation. Capital preservation is not fair, but it's somewhere along the line of fair, because the major emotions in this market once your money gets in is fear. Fear of losing that money, fear of missing out on opportunities. The next uh, emotion is greed. Greed of wanting to make big bucks overnight. You want to just get rich overnight. Greed of you seeing profit that you need to take, and it means your criteria of not taking. So these are the two emotions that happen, and they are because money is involved. But then beyond those emotions, your first thing in your mind, how do I preserve my capital? How do I protect my capital? Yes, you're gonna be taking opportunities, but then you are thinking from risk side of things, knowing that there are a whole lot of factors beyond your control that could alter things. You coming from this market, you are already one step ahead of time, coming with that market sense of how do I preserve my capital. And to do that, there are systems in place, which takes us to the next thing we're going to be looking at. Risk per trade. Never let one trade define your account, because you want to look this, it depends on how you are coming in to this game, if you are in it for the short term or long term. But I bet anybody taking his time to watch videos like this, putting in the effort to educate themselves and learn this skill, you are not in this for the short term, you are in this for the long term. So it's not a single trade that is going to make you rich. It's something that happens over time, repeatedly, brick by brick, little drops by little drops is what will make you rich, that you grow over time. So one trade is not what you will define your account. So risk per trade, what is that? So before, once you fund any account, example, I'm gonna use $1,000. You fund $1,000 or $100. It's easy, or $500. The first day you deposit that money is the first day you're going to do all this, ask yourself all these questions. Your first problem is not to go and be looking for opportunities, is not for you to want to make money just yet. First up, funding an account, 500, 100, $1,000. What should be in your mind is, okay, what is the plan for this particular account? It's from the beginning you're asking yourself, what is the plan for this account? What is my target for this account? In this $1,000, in this $500, how much am I comfortable to lose? Like, how much am I comfortable to lose? Am I willing to lose the whole $1,000 I deposited? Will I be comfortable losing the whole $500 I deposited? Will I be losing comfortable losing the whole $100 I deposited? You ask yourself those questions first. And if it's something that you're settled with, fine. If it's in $1,000, you're comfortable losing half of it, then that tells you that, oh, you have 500, which is 50% of that, to try whatever it is we are trying. After that, you're going to be disciplined and say, no, this is it. I'm either pausing at this point or not. Do you understand? So this first question is what will lead you to say, okay, in this 1,000, in this 500, in this $100, if in $1,000 I'm willing to risk 50% of that, which is $500, it will now lead you to the next question. You already know that in this whole $1,000, I don't want to lose this whole $1,000. I'm open to losing just 500 of it. Fine. In that 500 that you've exposed, question now is, per trade idea, how much are you going to be risking per trade idea? Because after you've done this whole analysis and you see a buy or sell opportunity, you want to ask yourself, okay, per trade idea, how much um, are you willing to risk out of this $500? You knowing that it's not just one trade that defines you, because um, trading is a game of probability. So what makes you a profitable trader is not one trade, it's not two trades, it's not three trades. It's a series of trade over time that, like, uh would determine if you are a profitable trader or not. It's not how many times you win, but then how much you make each time you are right. But then for this, or each of these opportunity, you're now thinking to yourself that, oh, out of this 1,000, I'm willing to risk 500. Okay, per trade idea, I want to risk $50. So what does that tell me? If I'm willing to risk $50, it means I have 10 trials before that 500 go. 50, 50, 50, 50, 50, 50, 50, 50, 50 per trade idea. Be it you want to buy, be it you want to sell, be it any other asset, you've already had a particular number that, oh, I'm comfortable risking $50 per trade. Maybe you are a bit more impulsive. You would say, oh, I'm comfortable risking $100 per trade in that 500, which means if it's $100, you have 5 trials, and after that 5 trials, if all of the 5 trials go south, don't go your way, then you are done, like, for that particular account. And maybe you might decide to go on a break, you might decide to maybe go reset. So you see how my head is thinking. I'm not thinking about how much I'm making. First off, you are asking yourself these questions because you want to be comfortable. You don't want to be panicking mid trades. You don't want to be taking decisions just randomly. So if you decide to take 50 to risk $50 per trade in $500, it means you have 10 trials. So you now knowing that you have 10 trials, if you lose the first trade, you know you still have 9 trials. If you lose the second trade, you still have like 8 trials. If you lose the third trade, you lose the fourth trade, like, you know you still have like 6 trials. And that, you've already have a plan. You are setting your plan. So per trade idea, you've already defined that, okay, per $50, you are comfortable risking. $100 per trade idea, you are comfortable risking. It determines, this is relative to everybody. It's not a one size fits answer. It depends on your account size and the condition where you are at that point in your life that you'll be comfortable. Maybe it might not even be 50, maybe it might be $20 that you're comfortable risking. Fine. That now you've already have an amount. Next up, you are looking at, oh, is there now remain, out of this $50 that I'm willing to risk, out of this $100 that I'm willing to risk, if the trade goes, this is you now, you've already considered that, oh, if I take a trade idea and it goes against me, I know that I'm losing $50. Yeah. So now you've started from the loss side of things. Next question you're asking is risk to reward. What is risk to reward? In my previous video, you hear me make mention of something like 1 to 2 risk reward, 1 to 3 weeks reward, and me, I told you that my preference is I go for 1 to 2 weeks reward. So in simple English, what that means is we have a zone here, right? We have another zone here, right? So after I've identified my market structure, I identified those whole other things, and I discovered that, oh, market broke this zone and it has been making series of higher highs and higher lows, right? And then price retrace back at this level. I saw my maybe at this point price came and I saw bullish engulfing confirmation. I'm buying from this zone. Example, my stop loss is below this previous low, which gives us I would have to go to a smaller time frame to be able to do that, but I'm just giving you an example. um Let me go to 15 minutes. This is daily. Every little thing I do is very escalated. So let's go to 15 minutes, because 15 minutes, 30 minutes is where you should be looking for this bullish engulfing thing, right? 15 minutes, 30 minutes for confirmation to enter standard. 1 hour better, but 1 hour for you that are a beginner, it will be too far for you. So 15 minutes, 30 minutes might be too far for you. So anywhere around from 15 minutes to 1 hour confirmation. But then as a beginner, I recommend you start from 1 hour confirmation first, right? Because the higher the time frame, the less noisy the market is for you. So if you want to do your and get your direction, you are using 1 hour to kind of like, after you come back down from daily 4 hour, 1 hour, and you are looking for your confirmations. Example of what I mean. So example, I saw this bullish engulfing candle. I'm buying, and my stop loss, ideally is supposed to be below the previous low, but this is way, 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 very wide. It's very expensive. This is very, 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 very expensive for you. So you're gonna be targeting somewhere below the previous low, right? So we are not even talking about the profit. So now you've already established that what stop loss means, that out of your $1,000, this is 190.67 pips. Okay, fine. This is the range. This is what now we determine the lot size you use. I made mention something about lot size in here. The distance between where your entry is and your stop loss is before you enter the trade is now what will determine, okay, when you want to go and trigger. So question now is, since I want to risk $50, say, for if this trade idea goes against me, this is what now will determine if I'm to use 0.01, 0.02, 0.03, so that when you do it to arrive at that $50. So then there are position size calculators where you could find on your FX book. But then how you will do that basically easily, because when you are trying to make this decision, the market is moving, it's not waiting for you. So when you already mark your zones before price reaches that zone, that's the time you would ask yourself all these questions and do all these calculations before price reach, so that when price reach, you've already done all these things. Not when price reach and you see an engulfing candle that you start doing all these calculations. Market will leave you, right? So example, this is 190 pips. Question is, okay, I'm comfortable risking this, and if I use 0.01, this is already 0.01, this is around $19, because it's $1 per pip on, example, a trade like gold. So if I use 0.02, that's like $18. If I use 0.03, that's around like 30 something. If I use 0.04, 19, 19, 19, 19. So that's how you use to do your calculation. And then the question now is, what are you willing to get? That's now when, after we've put this risk in consideration, now I told you 1 to 2 weeks reward. So what 1 to 2 weeks reward means is I'm getting double what I'm risking here. So it means if this trade to reach, for this trade idea, that I would have entered at this point, and I'm willing to do 1 to risk reward ratio. Can you see risk to reward ratio? 1 to 2 risk reward. If I risk $50, it means at this point I should be expecting somewhere around $100. Do you understand the idea now? So this is the minimum. Some people target as 1 to, however, but I'm telling you based off my own experience, standard you should be looking 1 to 2, 1 to 3, right? So what this means is, if this trade goes and my take profit is here, I will be getting double of what I risk, which is fair. You put 50 and after the trade goes, your idea you're getting 100. It's fair. You might, if you go 1 to 3 risk reward, can you see why 1 to, maybe you were targeting 1 to 3 risk reward? So look at some of the uh, uh, why 1 to 2 risk reward is reliable, because price would have retraced back and you would have been holding this trade over the weekend, which as a day trader we aim to trade and finish that day, not carrying over trades over the long. But maybe you might be comfortable more being a swing trader. Fine, it's okay. Whatever your preference is, there's no one size fits all answer here. So if you are targeting 1 to 3, it means if you reach $50, you are getting 150. If maybe 1 to 3 is small for you, you may be targeting 1 to 4 risk reward. It means you are getting 4 times what you are risking, which if you risk 50, you should be getting 200. If you are targeting maybe 1 to 5, you should be getting $250 profit from this. Is this making sense to you? So that's how risk management works. And standard, anywhere above 1 to 2 is good for you. You are okay with 1 to 2, but maybe you might want to aim higher. Fine, it's your preference, it's your choice. But then the higher risk to reward you choose, then you should be ready for retracement. At this point, we don't know if this trade is coming back to hit or is coming back to entry and continue. We don't know. But then if you have targeted 1 to 2, you would have gotten your $100 and you are good. And you are reset and you are waiting for the next week to enter your new trade. So that's what risk to reward mean. So can you see how before I executed my first trade, I'm asking this question. I started from what I was comfortable using before I asked what I was going to make. But then if you come just focusing on what you want to make the profit, you would get hot most times than usual, because you wouldn't even be aware of what you are risking. So never you enter a trade without knowing how much you'll be losing if that trade goes against you. So that is you managing risks. It has nothing to do with all those things that will guarantee say to make you entry. And the aim here with this, you are aiming to make more when you are right than you lose, right? Because over time, if you do 1 to 2, if I risk $50 and I get $100 on it, it means at the end, example, this trade that hit take profit, it means I'm having $1,100. I'm having $100 profit, and it doesn't mean when you are making profit you start increasing how much you were willing. The fact that I make $100 doesn't mean my next trade I should switch how much I'm willing to risk. You will still go with that same 50 that you started the account. So that's one of the mistake beginners make. Maybe you take profit, you see you hit 100, you do another one, you hit 100, you do another one, you hit 100. That's where that factor of the second emotion might come to haunt you, which is greed. You might say, oh, I'm good at this, oh, I'm invisible, let me increase my risk to maybe 200 per risk. You that were risking $50 and everything was going fine, because you have to look things over the long haul. You have to lose 2 times now of that 50 before you even touch your capital at risking 50. And if you might get hit, your stop loss might get hit the next trade, your balance will come back to 1050. Do you understand? Which gives you better advantage. Remember, in the whole transaction you said you were willing to risk 500, which you are having like 600 now. If you get hit now, you are having 550. If you get hit 2 times, you are back to your normal balance. If you take profit, you are back to that 100 again. you get another take profit, you are back to 700 again. But then your risk ratio on any type of asset you are taking, you are keeping it at that 50-50 dollar. So another thing now, since you've already determined per trade idea you want to be risking $50, that is now what will shape how many times you take trades in a day, how many times you take trade in a week. Do you understand? Because if you are willing to risk $50 per trade idea, question is how much are you willing to lose in a day? That will determine how many trade ideas you will take. So maybe in a day you said you will just trade two times. You are willing to take two ideas, which is you risking $100 then, yeah? Because if you say $50, if you do 50 by 500, you're having 10 trials per trade idea, right? Which means there are two ways to go about it. If you decide to risk that $50 on a single trade idea, that means you've exhausted one bullet. Just look at it. You have a gun, and for whatever time you shoot, that bullet is gone. You don't know if it's going to come back with another profitable bullet or not. Do you understand? So out of these 10 trials, you might say you want more. You want to have 20 trials. So you might divide that um 50 into 2, which gives you 25, which gives you the leverage to be able to risk $25 on a trade. And if you take two trades idea and you go wrong, which equals to 50. Is this whole thing making sense to you? There's another way where you say you are willing to risk $50 per trade idea, which means you'll be able to take one trade idea in a day and then you wait until the next day. Because if you go two times and the two trade idea go to you, you are losing $100 that day. So if you do $100 and it means you are having like $400 remaining, which means 4 days if you are going $100. So the roadmap of all this, you already know your fate predefined. So you are not being taken unaware. So that's why you see people say, so you can't lose your whole money in Forex except you become undisciplined by yourself and you break your rules. Because this thing you are setting is your rules that you are setting on. So you have to be disciplined to stick to your rules that you already set for yourself. So now you might decide to go 25, fine, that's based on you. You might decide to go 50, fine, that's based on you. You might decide to go 100, fine, that's based on you. But then out of your whole main capital that you deposited, you are to protect it. And these rules you are putting in trade, they are the ones to protect you. To now guide you that, oh, in a day, I have, if I'm going 50, I can only take two trade idea that day, and if they go wrong, I close my system, I go do something else, I come back the next day and try. I lose certain predefined amount I set for myself for that day. If it goes well, fine. And as you are setting predefined amount to lose, you are setting a target. And once you reach that target, you stop for that day. Else, there's high tendency you are going to lose that particular amount that you made. If you hit your target for that day, fine. Whatever opportunity that presents itself to you is none of your business. You go and you are done for that day. You come back the next day to try, because you can hit your target and you start facing the problem of greed, where you want to make more. You make $100, it's sweet, you want to make 200 again. There's a problem there, because the moment you lose that your money that you made that day, you start making some kind of impulsive decision, which will now lead to you blowing your account. Do you understand? So that is what the mindset you are coming to the market with. That's what risk management is. And it's very heavily dependent on you, because humans are unreliable. Your emotions are, you might be looking for money for rent, you might be looking for money for this. Our needs are endless, and that's why you see fear and greed are the two things that are going to be haunting you, because the system I gave you, the approach I gave you of taking it works. It's something that works whether you believe it or not, it does. But then that's a whole different thing. Now you you might go into this spiral if you don't stick to your rules, right? So we move on to position size. I already spoken about it, where it's your stop loss that you determine your lot size, not based off just you just see a trade idea, you just buy, draw your stop loss anywhere. You don't even know how much you are going to lose if that trade goes against you. If you don't know how much you were going to lose in before that you take a trade, then you are wrong. You should already, before you take any trade, you should already know how much you will lose if it goes against you, so that you're not surprised. You should know how much you are going to make if it goes in your way, and you're not surprised. And if you hit your target, be disciplined enough to stick to that target and leave it until the next day. So that will limit you. That's why you see, it's not advisable for you to have many assets that you're trading. Maybe you might have four. Like example, look at my watch list. This is just the trades. Most times, this is the I only trade gold most times. That's why you see most of my examples is with gold. You could see I got three different brokers with gold. I barely trade this guy. I barely trade these guys. It's because of this illustration I even brought you USD. I don't trade forex. I trade commodities. I barely trade oil. I only use this guy to know the strength of the dollar, but mostly the only pair I trade is gold. I'm a gold specialist, right? That's what that does for me, is it helps me limit the numbers of trade I take in a day, in a week, in a session. Do you understand? Because in a week I could only take maybe to to two trades in a week. Do you understand? That way I'm limiting and I am protecting my capital. But then only that one trade, you might be trading every day, trade, make profit, lose it. But then just my two trades will put me very over and above. Just my 2 to 3 trades in a week, and I'm there. But then as a beginner, you might be excited, you want to trade every day, you want to. No, it's not about that. It's about preserving capital. That's what makes you a professional trader. That's what makes you a profitable trader over time. How you are even able to protect what you are making, because it doesn't make sense if you are making and you're undisciplined and losing it and making it and losing it, and no. So that you should have it at the back of your mind before you do, because what you are aiming here is consistency. You are not looking to get rich overnight over one trade or just two trades. Just you, and a whole lot of this, you'll be fine and good on your own. But the problem is, in our world today, there's a whole lot of social media influence going on. So you might be good, you might make $100 on a trade. You go online, you see someone making 10,000, seeing someone make 20,000, you see someone making 50,000, 500,000. That can easily get to your head. So you have to protect your mind. You have to protect your head, what you are going into, because this guy making this 10,000, 1,000, 5,000, you don't know his journey. You don't know how many years he has been in that game. You don't know what he has gone through. You don't know the process. You don't know the stories. So to each his own. Don't focus on anybody's stories. It's good to look at other people's stories to motivate yourself and know that, oh, this key is a worthwhile one. This key is worth finding. But the moment you start wanting to compare yourself with people online, then you're going to be having a whole lot of problems in your mind, and it's going to affect your account. Do you understand? So aim for consistency. If you make consistently 1 to 2 over time, before you know it, over a series of 2 weeks or 4 weeks, you're gonna see growth. Growth is a gradual process. Growth is something that you might not see in the number. Over time, when you look back, you'll see that you've grown. So this is what the promptings you should know before you go on to fund your real account and start trading. You start trading as a professional from day one, and that's going to help you build good habits. And then, for my own recommendation on how to build discipline, I recommend, if you're a beginner, you start with prop firms. You start trading prop firms. You start trading prop firms because prop firm already, even aside these rules you are setting for yourself, it makes you more disciplined, because they've already put some rules in place that you would have to follow before you can make, even you make profit before you be able to withdraw. You would have a profit target, you have minimum trading days, you would have do's and don'ts that you're gonna be. It will help you as a beginner structure the way you trade as regards trading that your little amount. So if you have $100, you have a $50, I do not recommend as a beginner you go fund that $100 because it's a little amount in this market. $100, $50 is a little amount. So with your as little as $25, you could secure the least 5K two-step accounts with either funding pips, with either Atlas funded. These are the two um, prop firms I use. There are other good ones, funded next, but then I use funding pips, I use Atlas funded, and then uh, I'd recommend you start with a prop firm that is going to help you build character, is going to help you build discipline. Because if you're looking, even you're looking for investors are not worried much about percentage they're going to be making. They are worried about you being able to preserve capital. That discipline over time is what is important, because everybody could just come to the market, click buy or sell, and make lucky profits or not. But question is, how are you able to preserve that profit you are making? How are you even able to preserve your own capital that you come to the market? These are the big questions. These are the important questions, not how much you are making. So whenever it is you come, the structure I give you, start from what's the consciousness of what you're going to be losing first if the trade doesn't go as planned, because things don't always go as planned. You can see more than three confluences, it won't go as planned. Some days it will go as planned. So this is the risk involved, that uncertainty. So you don't know whether this or that. For whatever trade you're taking, there's no 100% trade. So this system now, you taking this approach is the wise approach for you to take, to be able to help you stay longer in the game and make you stay alive, to be able to take opportunities when they present themselves. But this conversation is for those that have already practiced, have already know market structure, are already good with their support and resistances, you know, already know how to identify uptrend and uptrend, already know your confirmation, you've tested on your demo, you've tested, and you are ready to go. This is where this advice will come to you. Maybe first time I might not be making sense, I might be speaking Chinese, but when you blow your first account, you come back to this video and it will make sense to you. And you remember that I told you that you should no rush. This thing has been here since 16th century, and it will continue to be there till eternity. So don't rush. Follow the process, follow the grind, follow the journey, and you'll be good. And I hope you would listen for just this part. I'm telling you, you don't have to go through pain to understand what I'm saying. But most likely than not, a whole lot of you will go and do what's on your mind. After blowing so many accounts, you come back to this video and it will make sense that you should be more cautious of protecting capital, more cautious of staying longer in the game than just wanting to hit it big one time. Seeing someone flip $50 to $1,000, seeing someone flip this to this to that, don't let it get in your head. Everybody has his journey. Follow your own journey and grow in your own journey. Don't just look at other people for motivation, and don't look at them too much. It will get in your head, because on your own, without all those things, you'll be good. But then the moment you start seeing flips here and there, it will get to your head and you want to try it, and you get hot. You get really hot badly. So that is it. I see you on the next one, where I speak about trading psychology, and that will be the last part of this session. And I hope at the end of this session, applying whatever it is I say, you become profitable and we meet at the top. So see you at the top, right? See you at the top. Stay blessed. Remain in the game. Protect your capital.